Hi, my name is Xun Zhong, and I'm Assistant Professor of Finance at the Gabelli School of Business. The paper I'm about to talk today is titled Information Aggregation and P-Hacking. It has been published at Management Science, and it's mainly a methodology paper. P-hacking is believed to be one of the common causes that lead to the failure to replicate academic work. Take the predicting of stock returns, for instance. So both academics and investors have been working very actively searching for signals that can predict future stock returns. With those signals, investors can construct very profitable trading strategies to either time in the market, or they can form some long-short portfolios that generate or delivers sizable risk-adjusted returns. So during this process, we really want to find predictors that are reliable. Therefore, we will heavily rely on statistical tests. What we usually do is to use the threshold of p-value less than 5%, which means that we are accepting a false positive rate of 5% using this threshold. So p-hacking involves using the same data set for multiple tests and analysis, but only report the ones that have statistical significance, meaning have the p-value less than the 5% threshold, and totally ignore the others have higher p-values. What's happening is that the actual false positive rate would be way larger than 5% if you use the standard threshold as before. This is a very dangerous practice, and the consequence of that would be incorrect or invalid statistical inference. It's a critical issue not only to asset management or the social science, but it's also a critical issue for other fields like medicine or biology. What we were doing is exploring another important but yet unanswered question about how is this p-hacking interacted with information aggregation. Nowadays, we already have more than 400 predictors for the cross-sectional stock returns. So aggregation techniques has been very popular. One of the major contributions of our paper is to sound the alarm that the standard information aggregation techniques would exaggerate the impact of p-hacking on the statistical inferences. But what's more exciting in the paper is that we proposed a new aggregation technique that is robust to p-hacking. So the trick is we pre-examine the relationship between returns and those signals, and we flip the sign of the signals that negatively predict returns. Then we apply the three-path filter regression just as it is. So now this little trick makes the method more robust to p-hacking, meaning when we apply predictability test to the combined predictor generated by our method, the p-value we get is much more conservative. Our paper suggests that academics or practitioners should be really alert when they use predictors that are a combination of pre-selected variables. But on the bright side, our methodology opens the door to downplay the contribution from predictors that are likely to be a result of p-hacking.